Let me throw up this refresher chart to take a look at the performance that we saw in May. It was the best month for gold since last July. So as expected, we see a little bit of consolidation for gold prices. What else is the market going to be focusing on?
Gold is being pulled by its physical attributes as well as the macro environment. And we've seen the physical market recovering at the start of the year, but over the course of May, it was really those macro drivers that came to the forefront. Investors shifted their focus from what the tapering risks might be, whether the Fed might be thinking about tapering, and shifting that focus towards inflation. And the view that the Fed viewed inflation as transitory really helped to lift gold prices higher. But that big turning point has really come from the ETFs. We had 5 of the past 6 months with hefty outflows. And then over the course of May, we've had inflows of around about 50 tons, which has really buoyed gold prices. And that's a key factor to watch in the near term.
Where do you see resistance in prices? And we're clearly looking ahead to the non-farm payrolls this Friday as well for another puzzle piece, if you will.
1900 has been a critical level for the gold market. If we look at where investors were positioned last time we were at 1900 back in early January, positioning was a lot heavier. So position the fact that around about tactical investors around about 17% lighter than they were previously, ETF holdings around about 4% lighter than they were previously. This bodes well for gold, but that 1900 level is proving to be quite tricky. But once gold prices manage to close above 1900 on a sustained basis, the next key hurdle is going to come around 1960. But what's been impressive is that gold market inflows, the ETF inflows, have been able to offset some of the weakness that we've seen from the India demand.
I was going to ask, how much does the physical demand really factor into prices, given, as you said, the weakening demand from India?
Gold market tends to rely on the physical market to provide the support on the downside, but it's really the investor demand that drives that upside momentum. So over the course of the first quarter and certainly into April, when we saw these hefty ETF outflows, the physical market was crucial in providing that floor for the gold market. And when we saw those dips below 1700, it was demand from India, from China, recovering across Asia that really helped to provide support to the gold market. And prices held up well because we were seeing that physical demand coming through. In the absence of that demand, we would have seen much lower lows for the gold market. So it's found a good support from the physical market, and now the upside is being driven by the macro environment.
Suki, one of those factors in the macro environment has been just the lack of chips, the global chip shortage that we're seeing. What impact will that have on the metals industry?
The second half of the year is quite complex when we're looking at the precious metals complex as a whole. On the one hand, we see some of the macro drivers continue to be supportive. We expect the dollar to remain on a weakening trend. We expect real rates to remain negative. But when we're looking at the industrial recovery that impacts the other precious metals such as silver and the PGMs, then we're looking at some nuanced factors that are really dampening the demand recovery. And certainly when it comes to the chip shortages, it's had quite a significant impact when it comes to platinum and palladium. We were expecting a strong recovery across auto production to lift demand for both platinum and palladium. But because of the chip shortages and recent estimates look like they'll reduce auto production around about 2 to 3 million units in the second half of the year, it looks like that demand profile will be a little bit softer. But for some of the metals, given that we have supply shortages, it doesn't impact their upside momentum. It means for metals like palladium, we're still expecting a hefty deficit.
Suki, are you seeing much meaningful reaction when it comes to conversations about Bitcoin and other cryptocurrencies being the new inflation hedge?
I think investors are looking to where they should be positioning when it comes to looking at the inflation risk. Yes, inflation has exceeded some expectations, and the Fed has said that they see it as being transitory, and we are seeing inflation tick higher. So across markets generally, investors are looking for where to be best placed when it comes to inflation. We're seeing that rotation in equities, and we've seen it across the precious metals as a whole. Gold has become back in vogue because we're seeing some of those inflation risks tick higher. And there is a debate whether cryptocurrencies is a place to be if we see inflation ticking higher as well. We don't have the same length of data that we do for the gold market to be able to prove whether cryptocurrencies would prove to be a good inflation hedge. But we have seen that during periods of high and unexpected inflation, that's when gold tends to be a good inflation hedge.